All right, let's get right into it. You know what makes financial experts just pull their hair out? It's seeing people pour money into stocks when they've got massive credit card debt hanging over them. It's probably one of the biggest, most expensive mistakes you can make. But don't worry, today we're going to lay out the exact step-by-step playbook for investing your money the right way.
And this quote just hits the nail on the head, doesn't it? I mean, you can shovel all the cash you want into your investment accounts, but if you've got this high-interest debt monster working against you, you're just spinning your wheels. You're losing money way faster than you can ever hope to earn it.
And for so many people, those holes they're not just holes, they're gaping chasms. Get this, $500. That is the median emergency fund for Americans. That's not even enough to cover a major car repair or a surprise trip to the ER. It just goes to show you how many of us are trying to build our financial skyscraper on a foundation of sand.
Which brings us right to the heart of the problem. People are investing in completely the wrong order. You know, it's like building a house. You would never ever install those fancy quartz countertops and a sub-zero fridge if you knew the foundation was cracked and sinking, right? Of course not. But that's exactly what's happening when people chase some hot new stock before they've handled the absolute basics. And man, look at the difference here. On one side, it's just total chaos. You're trying to invest while you're drowning in debt, you're literally leaving free money on the table, and you're letting taxes just chew up all your hard-earned gains. But on the other side, well, that's the optimal order we're about to walk through. It's structured, it's secure, and it's the actual path to building lasting wealth. So, let's do this the right way. Let's start from the ground up and build that financial bedrock. Seriously, before you even think about picking a single stock or an ETF, there are two steps that are completely non-negotiable. You have to do these first. Okay, step one is building that emergency fund. But here's the thing you have to understand. This is about so much more than just having cash for a flat tire. It's a psychological safety net. It's the buffer that stops you from making a terrible, panicked decision, like selling all your investments during a market crash, just because your car broke down.
So how do you actually build this thing without it feeling like this impossible mountain to climb? Easy. You break it into bite-sized chunks. First, just laser focus on getting $1,000 saved up. Do it as fast as you can. That'll handle most of life's little annoyances. Then you shoot for 1 full month of your living expenses. And once you've got that, then you can work your way up to the big goal, 3 to 6 months worth. See? It makes this huge, scary thing feel totally doable.
All right, with that little safety net in place, now it's time to declare war. We are going after the single biggest wealth killer on the planet, high-interest debt. You should really think of this stuff as a financial cancer. We're talking about anything with an interest rate over, say, 8%. And the number one villain here? Credit cards. They're often sitting at 22% or even higher. It's insane.
And this is why it's so incredibly important. Think about it. Paying off a credit card that's charging you 22% interest, that's the same as getting a guaranteed 22% return on your money. Let that sink in for a second. The stock market, on an average year, might get you 10%. By paying off that debt, you are literally locking in a return that is more than double the market average, and you're doing it with absolutely zero risk. It's a no-brainer.
Okay, so the rule is set. Pay off that nasty high-interest debt before you seriously invest. But, like with most rules, there is one huge, glaring exception. There is one investment out there that is so ridiculously good, it gets to jump to the front of the line.
Let me just ask you this directly. What would you rather have? That guaranteed 22% return we just talked about from paying off your credit card, or a guaranteed 100% return? I mean, the answer seems pretty obvious, right? But you'd be shocked how many people walk away from this deal every single year.
Yeah, you take the 100%, you take it every single time, no questions asked. This incredible return is what you get from your employer's match in your retirement plan. It is the closest thing to free money that exists in finance, and grabbing it is the very next step in our perfect investment order. So what is this employer match? It's simple. It's when your job literally gives you money just because you save some of your own. A super common example is they'll give you 50 cents for every dollar you put in, up to 6% of your salary. That's an instant 50% return on your money. Sometimes it's a dollar-for-dollar match. That's a 100% return before that money has even been invested for a single day. You cannot afford to miss out on this.
So once you've got your emergency fund started, you're crushing your debt, and you are getting every last dollar of your company match, now the game changes. We're officially shifting from defense to offense. Welcome to the tax optimization zone. This is where we start using special accounts to legally protect your money from taxes and just pour gasoline on its growth.
So right after securing that match, your next move is usually funding an IRA, or an individual retirement account. But this brings up the age-old question, Roth or traditional? Look, it really just boils down to one simple question. Do you want to pay your taxes now, or do you want to pay them later? If you think you'll be earning more and be in a higher tax bracket when you retire, the Roth IRA, where you pay taxes today, is probably the way to go. If you think you'll be in a lower tax bracket in retirement, then the traditional IRA, which gives you that nice tax break today, might be the better fit.
Now, for people who qualify for one, we have arrived at what might just be the single greatest investment tool ever created. I'm talking about the Health Savings Account, the HSA. This thing is like a financial superhero. It's a retirement account on steroids that has not one, not two, but three massive tax advantages.
Okay, let's just break down how amazing this is. First, the money you put in is tax deductible, which lowers your tax bill right now. Second, that money grows completely, 100% tax-free. And third, when you take it out for medical expenses, now or in 30 years, those withdrawals are also completely tax-free. It is the only account in existence that gives you a tax break at every single step of the way. It's incredible.
So, only after you've checked all those other boxes. You've gotten your match, you've maxed out your IRA, you've maxed out your HSA, and then you've even gone back to max out the rest of your 401k. Only then do we finally get to the last step. And ironically, this is the step that most people try to start with, the plain old taxable brokerage account. So why is this dead last on our list? Well, it's because of a sneaky little thing called tax track, and the impact is just staggering. Look at this. If you invest $10,000 a year for 30 years in a tax-advantaged account like a 401k, it could grow to almost $950,000. But that exact same investment in a taxable account, where you're paying taxes on it year after year, it might only grow to about $700,000. That's $250,000. Poof! Gone! Just because of taxes.
Now, that doesn't mean these accounts aren't useful. They absolutely are. Their superpower is flexibility. You can take the money out whenever you want for whatever you want. They are perfect for those big goals that happen before retirement, like saving for a down payment on a house, or for funding the first few years of an early retirement before you can touch your 401k without a penalty.
Okay, let's put it all together. Here it is, the whole blueprint, the smartest order to invest your money, period. Step 1, build an emergency fund. Step 2, go to war on high-interest debt. Step 3, capture every single penny of your employer match. Step 4, max out your tax-advantaged accounts, like an IRA and an HSA. Step 5, circle back and max out the rest of your 401k. And finally, Step 6, invest in a taxable brokerage account. That's the playbook.
Following this exact sequence, in this order, ensures that you're building your financial future on solid, unshakable ground. So I guess that just leaves one final question for you to think about. When you look at your own financial situation, are you building your house on bedrock, or are you building it on quicksand?